Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Michael Purves, with decades of experience at Tallbacken and particularly with a wonderful Asia perspective. Let me cut to the chase. Is Japan idiosyncratic?
Well, I think what's really idiosyncratic with Japan right now is the fact that their 30-year bond is, that yield is surging, right? And it's an interesting contrast because in the United States, for all the time we talk about the Fed and the chair and inflation and all this interest rate stuff, the reality is that rate volatility in the U.S. has been extraordinarily low, perhaps until last night there. And rate volatility overseas is doing, in Japan particularly, is doing very interesting things. I think so. What's happening is that we're kind of importing a little bit of rate volatility from Japan right now.
Well, I got to impress Purves here because he got up so early to be with us. So I took the 40-year piece in Japan, quoted in yield, I figured it out in price, and I looked at a standard deviation study. And you and I know that 4 standard deviations is where things get exciting. Yeah. The price has gone 90-something to 83, and 4 standard deviations is only 1 point more. From 83 to 82 really begins to show the stress. Yeah. Does that matter to the global bond market that we're coming up on a 4 standard deviation move in some of this stuff?
Well, I think you're seeing a little bit of it. It matters a little bit right now to the global bond market. It's funny if you look at calculations of the term premium, right? For several years, that term premium for the U.S. Treasuries was extraordinarily low. At the same time, the Japanese and European yields were in negative territory. Now there's no more negative yielding debt. That's been the condition for a while now. And our term premium has been at a much higher elevated level. So we do have to, contextualize our treasury yields in a global in a global construct. We import and export interest rates just like other countries do. It is one big global bond market. But to get back to Tom's question, the question is how much does it really matter here, right? And I think right now Japan is clearly very important. Is it going to yank our 10-year up to 4.75%? I doubt it, but it's sort of a subtle underlying pressure there that will sort of ultimately, reinforce valuations for treasuries, on our side.
Well, boy, I mean, again, I've been sitting on a beach for a week. I come back, the 10-year U.S. Treasury, 4.29%.
Yeah,
what's going on there?
Paul. Did you see the 30-year bond?
Yeah, I know, the 30.
4.19. We're on the 5% watch.
We are.
It's a crisis.
And look at the, there's the big steepening yield curve. What do you make of the longer end of the U.S. curve here?
Well, look, I think there's been this tension for some time, really over the last year or so, that actually really started in September 24 with our cutting cycle, where we cut 50 basis points in September 24, and that marked the low in interest rates for that part of the curve. And so normally, and when you start a cutting cycle, all interest rates tend to go lower, right? And in this case, it's sort of been the opposite. And I think there's this thing about the term premium, or the steepener, if you will, being sort of sticky, higher, longer. Why is that the case? Part of it is because, we've been cutting into generally pretty good growth and pretty low unemployment and pretty resilient inflation. And I think part of it is back to our earlier discussion that we're importing some of this from other countries, for example, Japan, right? So the global bond market is kind of lifting our back end as well. I think that it does create a challenge. I do want to talk about rate volatility a little bit more, though, because I think it's important.
Wait, who's doing the interview?
He's a pro.
Folks, Michael Purves with us across the nation right now, a clinic on rate volatility. And on YouTube, subscribe to Bloomberg podcast for our rate volatility interview. Go.
Look, it's a subtle thing, but the MOVE index is extraordinarily low right now, right? And if you look at the range of the 10-year Treasury yield over the last couple of months, that range is about 20 basis points. You take the highest point to the lowest point. You go back to 1980, That's the tightest range in the 40 plus years, right? So why is that the case when we have all this drama about who's going to run the Fed and all that kind of stuff? I think part of this goes back to the fact that if, let's say, we get a super dove in as a very dovish set of policies coming out of the Fed, prospectively, well, that is offset by higher term premium, and that it's kind of tends to dull the overall volatility picture. Similarly, if we were get a more hawkish than expected Fed in the coming months, that would reduce the term premium there, given this sort of backdrop of sticky higher inflation north of 2.5%. And an economy that's still pretty good, and these foreign bond yields, right? So it's, but then keeping it in a very tight range, an unusually tight range, it is breaking out literally just as we talk to higher levels. How much it breaks out, I think we'll have to see, because I think you have to get back to U.S. fundamentals too.
Michael, what are clients doing these days? I mean, we have the market futures down at 1.5%, Europe trading off over 1% here today. Geopolitical risk right back on the front burner, I guess. Are they buying risk? Are they buying protection? What are your clients doing?
They're buying risk, but they're very much, if you're an equity a fund, long short or long only, you are a stock picker right now more than ever, right? Implied correlations across the stock market are at record lows. They're spiking right now, but off record lows there. And I think they're really being very sort of careful. I think the protection, in terms of hedging market risk, there's a lot of anxiety because we've had, 3 amazing years. Maybe we'll have another good year, but people want to, protect gains, after such a great run. It's hard, I think, with, buying VIX calls or S&P puts, simply because the correlations across stocks are so low, and that tends to suppress movements in surges in the VIX. When you have, we step back, we have some level of monetary easing on top of fiscal easing. We're going to get stimulus just clocking in soon, on top of a pretty good economy, right, with this massive fixed asset boom there, and that's driving correlations low. So the violence within the market is within the market. It's rotation and all that there. So when you wake up on a Saturday morning and there's a Venezuela headline like we had a couple of weeks ago or whatnot, what I've been saying, if you want to hedge those kinds of risk, don't do it with VIX calls or S&P puts. Do it with long gold or gold in some form. Michael
Purves with us, folks. We welcome you on the Eastern Seashore. Nathan Hager Radio, 99.1 FM Washington, 92.9 FM in Patriot Land. Bloomberg 1130 here in New York. Good morning. The way you listen to a Sirius XM channel 121, particularly across Canada. Stay warm out there. The cold coming for the next 15 days. We're efforting Rob Carolyn to give us historic perspective. Paul, like in 10 days, it's like the coldest I've ever seen in New York.
Yeah, it's going to get there. Yeah, and they got in the Midwest right now, they're getting hammered. So
are you surfing?
Yeah, exactly. No, stay close to home.
Michael Purves here. And let's talk, folks, basic equity market. I'm going to be filtering in, folks. I worked all weekend. The zeitgeist was just absolutely unreal. And just now, as an example, Adam Posen, Peterson Institute, Justin Lamond, I haven't read it yet. I'll not read it in French, Michael, excuse me. But Dr. Posen, Europe has crossed the Rubicon. Good. Here is a guideline for what to do now. I'll report on that in a moment. What it comes down to is, what do I do with my 401k, given a cacophony of news flow? How do you distill President Trump zeitgeist, if you will, to an investment portfolio?
Well, I think this is sort of a tired cliche, but I think it does speak to diversification, right? If you diversified into European equities a year ago, right, you vastly outperformed pretty much any part of the U.S. equity complex. They're probably not only in local terms, but particularly so in dollar terms there. And I think that's part of where, there's so many unknowns with respect to how all this geopolitical realignments are going to shake out. But if you step back, look, it's not just the U.S. economy that's doing pretty well. It's most economies in the world are doing remarkably well. I was talking to a friend of mine just yesterday about European exports, and he was like, European exports to the U.S. represent less than 3% of German GDP there. And so I think there's a lot of important things that are happening outside the U.S. where there's really great opportunities, and particularly if Europe really goes from a narrative to actual action with respect to the some of the stimulus in reaction to this geopolitical alignment, there's going to be a lot of great earnings growth there, and probably a strong sequel to last year's performance.
Torsten Slok, our good friend at Apollo, is out with a note this morning saying companies with negative earnings continue to outperform companies with positive earnings. And now this is since Liberation Day. What does that tell you here? It seems like investors are willing to take on even more risk.
Yeah, look, you have, I'm going to get back to this comment that when you have concurrence of monetary stimulus in some form, we are in some form of easing cycle, we don't know how much, but we are cutting into 3% unemployment and robust GDP. And you have that combined with the fiscal side, late cycle, and you have an unbelievable fixed asset boom measured in trillions. Like 4 companies are spending more than most federal governments are around the world, just on CapEx. And then you have deregulation. Like, you kind of have to be risk on.
Yep.
I think you're waiting for those negative earnings companies to suddenly get killed. And they probably will at some point, but right now it's a reflection of the risk setup.
20 seconds. So you're not selling NVIDIA today because of the madness going on in Europe and in Davos?
No, I don't think so. I think there's a lot of you have to recognize, we could have a higher, more volatile equity market and still have positive equity performance. Like, if you look at the 1998, 1999, 2000 period, you had great equity performance. The VIX never got below 20.
Thank you. Michael Purves, just fabulous. Very fortunate to have you. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Steve Laipply's with us, global co-head of iShares Fixed Income at Lawrence Fink & Company, BlackRock. And I just want to say, folks, I've got a nodding acquaintance over the years with Klaus Schwab, and I know there's been a huge amount of controversy about Dr. Schwab. Somebody had to come in and pick up the debris. And Larry Fink, the bond trader from UCLA, is the one who said, I got a Rolodex. We're going to save this thing. And Paul, I don't think enough can be said, given the moment of President Trump, of what Larry Fink has done. Steve Laipply with us. What's it like working for Larry Fink? Like, if you see him on the elevator, does he talk to you?
He's quite friendly, actually. Yes, you bump into him on the elevator once in a while, but yeah.
I mean, what he's done in BlackRock's done. I mean, how much did you bring in last year, the GDP of Greenland?
Well, so, I mean, the industry had an amazing year. The industry took in, high 600s in bond ETF flows. In the United States, we were well over 400 of that. iShares itself took in around 180 billion globally of that in fixed income ETF flows. So, yeah, it was a monster year for bond flows in general and for ETF flows in particular. Industry is, sitting well above $1 trillion now. 1.2 odd.
Where are you putting all that money then? I mean, that's got to be the hardest part of your job, is where do you put all that money every day?
Well, I think we've talked about the sort of, I think, cautious behavior of investors. A lot of the money went into short-end treasuries. Okay. So we had close to $40 billion in our T-bill fund, SGov. But we also had a fair amount go into our active income fund, Rick Reeder's fund, BINC. That doubled last year.
Excuse me, Chairman Reeder?
No comment on that. But yeah, that fund doubled to around $16 billion last year. So the flows are pretty well spread out. I mean, I do think investors are highly focused on income. It shows in the flows. You have a lot of flows going into the short end of the treasury curve, but a lot of income generating assets as well.
So 2025 was a really good year for fixed income, high single digit total returns here. Is 2026? Am I just clipping coupons here? Is that how I should approach it?
Well, today might give people pause, but we've seen this movie a lot. So it's funny because just last week, everybody was talking about how the 10-year hasn't moved in months. I mean, if you look at the average, it was 415. Now we're at 430, right? High 420. So this volatility comes and goes. We've seen the 10-year round trip all the way close to 5, back down to below 4. And, here we go again. But I think long term, investors are looking through that in just trying to clip coupons.
I mean, Secretary Bessent with Maria Bartiromo. I'm bringing in a hat tomorrow because Maria's wearing like this killer hat in Davos.
Okay,
and I got my Maria hat. Maria's with the secretary, and he's talking about equivalency to Liberation Day. The three of us, and Lisa, we remember what our 201ks did Liberation Day. How do you buy the dip in bonds? I mean, I get it how to buy it in the equity market. If yield up, price down, what's the process to buy the Steve Laipply dip?
Well, let's look at it two ways, right? What's driving today? You have the JGB shock. That's part of it. You have concern in general over U.S. term premium. If you look at term premium, it's kind of, it's higher, but it's been higher than this, right? So it's been bouncing around a lot. I do think there is something structurally long term. We've been cautious on the long end. What we've been advocating forever is, stay sort of in the belly, look at, really just trying to generate income while mitigating duration. You can't eliminate it, but you have to go out on the curve a little bit. So I think just sort of staying in that intermediate part of the curve, it can be a rough ride, for part of it. But overall, if you look at the last year, in the last couple of years, it's been great to sort of just sit through that volatility and earn that income.
So talk to us about just kind of what you think this Fed is going to do this year. I mean, I guess the market's looking for 1 or 2 rate cuts. Is that kind of where you guys are?
I mean, we think if you look at how the dynamics of the economy have played out as of late, we think inflation is, yesterday's problem and labor's today's problem, right? So you've seen, a pretty significant slowdown in labor growth. And so I think that's sort of what the focus should be.
Mm-hmm.
So the market is pricing in 2 cuts. It could be more. I did hear, I was listening to your show the other day, and Anna Wong was calling for 4.
Mm-hmm.
So,
you listen
bid 2 off of 4. Yeah.
You listen to our show.
Actually.
Lisa, can you be sure he gets merch on the way out?
Yes, right.
What did Dr. Wong say?
She was calling for 4, if my ears serve me
correct.
right. So, we're kind of, the market is pricing in 2, close to 2.
Yep.
So we'll see how that plays out. But labor market certainly has slowed. If you strip out healthcare, it's been negative in the latter part of the year.
So fixed income, I mean, you can hold your head high at any cocktail party these days, right? I mean, because you guys had great returns, very strong returns in 2025. Coupons still a nice way to play the game in 2026. How much risk do you want to take? How much credit risk do you want to take?
I mean, and this is the part about being diversified, right? And that sounds like a throwaway answer. It's not, because right now, credit spreads are really snug. Now we're going to have a repricing today, but they were approaching very, very historically tight levels, and so what we've been seeing investors do is buy multi-sector, right? So you're, the ag, yes, but also things like Banca, things like our new total bond fund, BTOT, and also something simple like I-bonds, right? That defined maturity concept. People are worried about yields bouncing around. We've seen a lot of wealth investors just buy these defined maturity products, write them down, and let them mature.
What does BlackRock say about international bonds? Damien Sassower is taking all of January off because, they did so well. I got the equity market in Japan up 65% in U.S. dollars since the Liberation Day festivities. Do you do back-to-back in bonds and get that kind of return?
So as far as international goes, we like hard currency EM relative to local. I mean, last year local.
What does that mean?
So dollar or euro denominated, right? So you're taking the FX.
You want Malaysia paper that's in euro or dollars.
I think it was overall. I mean, local currency returned quite a bit last year, but I think hard currency overall takes out some of that FX volatility. In general, though, are you going to rinse and repeat? I mean, you don't know, but this is still a very, very attractive market for fixed income where yields are sitting now. You're going to get yields moving around, but it's a great market for fixed income.
Global co-head of iShares fixed income. It's got to be the easiest job in the world. The money's flowing into you, dude.
Like 2 hours a week.
I mean, come on. I mean, talk to us about just the ETF. Where do you think we are in that kind of evolution? Because Tom and I grew up with a mutual fund world in Boston, going to Boston 4 times a year to see our mutual fund clients.
Do you have lunches with ETFs? Do you go to lunch meetings like in mutual funds?
I mean, yeah, we have lunch meetings.
Okay. So it's the same.
But are we in the early stages, or are we kind of?
Yeah, no, very early.
Wow.
I mean, so we're, if you look at the global bond market, we're less than 3%.
Really?
Right. So, we are far behind the curve in terms of equity ETFs versus equity markets. Bond ETFs still have a long, long runway.
Really?
So I think we're just now, we're in early innings. It's a fast river, but it's early innings.
Steve Laipply, thanks so much with BlackRock. Seriously, thank you for the comments on leader Fink, as they would say in China. Steve Laipply is with BlackRock. Paul, I mean, it wasn't the same with Alexis. I mean, I'm sorry. 80-50 Duke Stanford, 71-56 Duke California. Yep. SMU was close, 82-75. And now Wake Forest, and is it like the best season ever for the Dukes?
Yeah, until we get to the March, and then you need experience, and we don't have experience because we have kids.
Everybody's 17. It's like
everybody's
the Montreal
17.
Canadiens.
So it happens every single year. We win the recruiting wars. We win the regular season. But when it comes to March, it's a tough time. So maybe we'll see how these guys play out here.
I feel the same way about the Montreal Canadiens.
I saw Cooper Flag at Madison Square Garden yesterday. Phenomenal.
Oh, listen, Lisa, can we get Sweeney's life? Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Michael Darda. He's just outstanding. I can't say enough about his use of economics folded into market analysis. He's managing director, chief economist, Roth, and we're thrilled he could join us this morning. Michael, you and I go way, way back, and I would suggest this geopolitics has a different color to it. The tone of Mr. Macron at the meetings of the World Economic Forum, the tone of Stubb of Finland. How do you synthesize that into your economic and market analysis?
Well, Tom, I mean, it's really difficult to look at geopolitical risks and translate them directly into earnings trajectories or even, what happens to financial markets. But it's certainly a unique time in history, in a little bit of a nervous time because equity market valuations in the United States are quite high, just above a 22 forward multiple. That's where we started 2025 and ended 2025 with quite a bit of volatility in the spring of last year. So that's really the question. I mean, all of these moving parts, whether they're domestic disturbances or international ones with high expectations, how does this all come together as 2026 unfolds?
I essentially worked all weekend, folks. A major shout out, William Rhodes in Project Syndicate, writing a blistering essay on the moment at hand, Paul. He's 91 years old. We say good morning to Brown University's Bill Rhodes. Michael Darda, you got the single sentence of the weekend. No, 7 to 8% nominal GDP growth is not a good idea for the next Fed chair. Why does the next Fed chair not want China GDP?
Well, Tom, straightforwardly, because we don't have a supply side of the U.S. economy that can grow 5 or 6%. And so if you have total aggregate demand, which is what NGDP is, total nominal spending, growing at nearly double-digit rates, you're going to have very high inflation. And we just went through that in 2021, 22, and the American people hated it. So I'm not sure if that was a bit of a miscue or misstatement on the part of the Treasury Secretary, but those kinds of numbers would be highly inflationary, in my opinion. Even if you're optimistic on AI and productivity, we are getting a little bit better productivity growth in this cycle versus the last, just over 2% versus a 1.6% average in the last business cycle. But a 7 to 8% nominal growth handle on top of that, take 2 percentage points away from 7 to 8, and that's your trend inflation rate. That's way too high. It's just preposterous, frankly.
Hey, Michael, we're once again here today dealing with a frequent discussion point, which is tariffs this time, maybe with our friends over there in Europe here. How do you kind of frame out some of that, given our experiences from April of last year?
It's unfortunate because this has been so chaotic and it's creating a lot of business uncertainty. I mean, the U.S. economy absorbed a 100-year tariff storm last year brilliantly, largely because of the actions of the Federal Reserve. They kept nominal growth almost perfectly stable, just above 5%. So the slowdown in the real economy was minor, but there was a fairly significant cooling in the labor market where private sector job growth actually was cut in half last year. And we think that owes largely to the uncertainty spike last spring. And, tariffs, if they're chaotically applied and you have all this uncertainty and there are legal questions about this as well, just not helpful. I mean, the U.S. economy has really been brilliant in coming through these shocks. Fed Chair Powell, after obviously stumbling in 2021 and 22 with NGDP that was way too fast. I mean, he's had a brilliant save here and has guided this soft landing incredibly. Really, it's a historic situation we've never seen before. Maybe, the closest parallel would be the Treasury Fed Accord of the early 50s, where we came off of high inflation, high nominal growth and into a period of stability. But that happened under quite different circumstances. So the Fed has been brilliant here with a lot of shocks and perturbations in the supply side of the economy in particular. And what thanks does he get? Justice Department criminal investigation. I mean, it's shameful.
So where do we go here, Michael? I mean, if you're the Fed here, I mean, the data, you could make an argument that they should just sit pat here, but the market's pricing in, maybe 2 rate cuts this year.
Yeah, Paul, great point. I do think the Fed is on hold here until further notice. What does that mean? If we look at when the Fed was cutting rates in 2024 and 2025, those cuts happened after the unemployment rate started to move upward in a persistent way.
Right.
And, just recently we had some more stable numbers for the unemployment rate. It did rise modestly last year. And so I think they're going to be looking really closely at labor market slack as a proxy for whether the economy is growing above or below trend. So if we kind of just flatline here with the unemployment rate, they're going to be on hold.
Margaret Darda of Roth, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Lisa, Paul was sitting there at the bunker. He's got the rum punch rocking at 10 a.m. And he's going, is there a time change with Aruba?
They're an hour ahead.
They're an hour ahead.
Yes.
How confusing.
Exactly.
And, he's like, I miss newspapers.
Yes.
That's what he was thinking.
That's what happened.
Lisa Mateo with the newspapers.
You got it. Okay, so here you go, your daily dose. So this is a look into the labor market for top business school grads. This is in the Wall Street Journal, and they say they're having a tough time landing jobs, even considering taking pay cuts. They're saying it's taking them months to land, accept offers. There were some rebounds for some of the elite programs like Harvard and Columbia, but hiring at a lot of still those top-tier business schools still below pre-pandemic levels. They gave an example like Georgetown University School of Business. Some of them still looking for work 3 months after graduation. It was up about 16% from the year before, so more of them having a tough time finding a job. The reason why, well, Georgetown is saying basically more than half of their graduates were international students, so visas can be an issue. But the Washington, D.C. labor market, it was flooded. You had a lot of federal cuts, so they're having a tough time finding jobs because so many more people looking for jobs. AI also an issue. They're competing against candidates who were laid off, like from that exact position. And there's some are changing career paths. They're looking for pay cuts.
I look at this, and I guess it's cyclical. Like there's just times where it ebbs, but you wonder, Paul, is this time different? Is this like just?
Well, what's happened in having sat on the board of the Duke Business School for 12 years, the business school is changing big time. If you're not a top program, you're really struggling. So a lot of schools, major schools like Wake Forest, have shut down their daytime programs in general here, and there's lots of one-year programs that are supplanting the MBA. So it's tough out there because, again, the economy's generally been pretty strong and people have jobs and they don't want to step back.
They're saying they're trying to increase networking efforts, but also train them in AI too before they graduate.
Next.
Okay, this is interesting. Okay, so there's an Italian bank that is breaking the mold. It's called Banca Promos. It's located near the Naples waterfront. It makes about 3 million euros a year from trading. It's just a little fraction of the billions that the big, trading houses earn. But it's 8 traders. They match buyers and sellers in 50 countries. The biggest difference is that all of them are women. Yes, it is a rarity in the business. Okay, the bank says it's a coincidence. It has a large share.
All 8 traders are women, and it's a coincidence.
It's not. So the CEO is a woman. 19 of the bank's 30 employees are women too on top of it. And the traders say they created a culture that is less combative and more supportive.
Oh, here we go.
Sure.
So you're back,
great
so
story.
we get this. Well, Alexis, there's a point, Paul, when you weren't here. Alexis, I had to shut down the show because of the girl talk.
Oh, yeah.
I mean, Lisa and Alexis
I
going
know.
back. It was too much.
There's a lot of girl power.
So
yeah.
what's your observation that these 8 traders are just killing it?
They are killing it. And their hope, maybe that'll kind of set a precedent. Who knows? But it's just something that's different out there that you're not seeing. So we'll see what happens. Okay.
All right. In Naples.
Okay, this one, the Sphere in Las Vegas, right?
Yes.
Everybody loves that. I don't know if you've been. You've been?
Have you been?
No, I thought you did.
bought the ticket.
Oh, no, you were
the
supposed
ticket
to.
ended up
Okay,
being
yeah.
fraudulent.
Oh, yeah.
This is the whole
Okay,
so you
bad story.
and there's a new one,
Bad
right?
story.
There's like a mini sphere.
So there might be a mini sphere by the National Harbor in Maryland. Okay, so it's mini because about 6,000 seats compared with the sphere that's 18,600. But it's going to have the LED displays, the special effects, and it's jobs. It's going to create about 2,500 jobs during construction. This, according to Governor Wes Moore, 4,750 jobs once it starts. Millions in additional revenue in the county and the state.
And this is going to be right where we go all the time, the National Harbor.
Yes.
That's where we went for our various conferences down there.
Yeah, and it's a big, a big place. There's a lot of entertainment, places and restaurants. It's, it's jam packed over there.
Yeah.
But we'll see. There's some, people are saying, oh, we don't need it in the area because it generates all these lights and traffic and all that. But it could be a boost.
Lisa Mateo, the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.